Hello, this is Corner Invest. So today I'll be talking about Singapore stocks in general. So if you look at the STI index, right, it is made up of banks, REITs, and commodity stocks. So commodity stocks, they are very low quality in nature. They have no competitive advantage. It is just who sells the lower price wins the game. So that those stocks are brushed aside. I mean, you can get a 7% return from them based on their dividends, and if the capital gains are about 1 to 2%, that's around 8 to 9% a year. But that is a low quality branch that I'll just leave it out. It's not a very good investment. So next one, if you look at REITs and banks, so for your REITs and banks, right, the banks are a lot better, yes, but the REITs, they are similar to your commodity as well. So your real estate are also sort of like commodities. If you think about it, it is less commoditized than maybe your grains, your salt, your wheat, but most of them, they have no competitive advantage. The only competitive advantage that they have is for someone to visit their mall instead of another competitor's mall, which I don't think is a very good competitive advantage at all. So for your Singapore REIT, they have a payout ratio of 90 to 100%, and so I don't think they're a very good investment at all. And yeah, they are quite undervalued now because of the interest rates, but once the interest rate normalize again, I'm looking to get out of all these Singapore REIT stocks. It is not a very good bet in this current environment. It goes against my principles. Last one, Singapore banks. So the Singapore banks are the best of the bunch. They have incredible management. They have good quality balance sheet. DBS, I recently looked into the numbers. If interest rate go back to 3%, there are two different scenarios that can play out. So one of it is what I call the worst case scenario. So 2 years back, 1 year back actually, I think in 2023 Q4, correct? So in Q4, the DBS CEO said that for every basis point drop in the interest rate, DBS net interest income will drop by about 10 million. That's what he said in Q4 of 2023. And then he said in Q2 of 2024 that it will be closer to 4 million instead. So let's say if we were to consider the worst case scenario, what happens is DBS earnings will drop by about 10%. And so the stock price will probably drop around a 20%. And then the less worst case, which is the base case, DBS earnings will drop by about 4%. And so the stock price maybe will drop 8%, 10%. It is normal. So for me, I think the banks are one of the most resilient ones. Even during COVID-19, instead of all these different REITs and your SIA as well cutting all the dividends, all these banks continue to pay dividends, and the dividend payout ratio for all these banks are at 50%. It's very healthy. They can increase it to 70, 80% and it's still healthy for them. So out of all these different stocks in Singapore, the best one will be your banks. But for me, I don't think it is right to find stocks in Singapore. It is not very high quality. So when you're trying to examine how to buy a stock, when you're trying to examine what to buy and pick stocks basically, what you need to do is to find stocks with both predictability and growth. So unfortunately for all these stocks, right, in Singapore, so for example, your banks, your REITs, there's no predictability because it is interest rate sensitive. So when your interest rate go up, your banks will benefit and then your REITs will suffer. And then when your interest rates come down again, your REITs will benefit and your banks will suffer. So there's no predictability in that. There is no sustainable earnings. Okay, there is to a certain extent for your banks and your REITs, but it is very macro driven. It is not very predictable. So when you try and find companies, you want to find companies that are extremely predictable. So for example, your Visa, your MasterCard, VeriSign, those companies have stable growing earnings for the past 10, 20 years, and they'll continue to do so all the way throughout lifetime. And then the next one that you need to look out for is for growth. So if you think in terms of the Singapore market, right, the highest growing ones are the banks, and the banks are growing mid-single digits to high single digits. And that is not very high growth rate if you think about the grand scheme of things. And then you have your REITs over here, it is not growing earnings. And then you have commodity prices going down as well, hurting all the commodity stocks. So in the Singapore market, there's no one company that is growing at an exponential rate. It's not growing at a very fast rate. Maybe you have SETS, but the problem with SETS is they are extremely leveraged. They have a debt to EBITDA of 11 billion. They bought a company at a peak of the interest rate cycle where they had to pay a lot of interest rate payments, and that wasn't a very right decision, I feel. So for all these Singapore stocks, they don't have high growth, and some of them, a lot of them lack predictability as well. I think the most predictable one are the banks. They paid interest, they paid dividends even during the COVID times. So for all your Singapore stocks, for me, I'm looking to transfer everything to just one stock, which is DBS. DBS is great. Hopefully it plunges maybe 20-30%. I'll start adding into it. But for now, I don't think exposing yourself to Singapore stocks is a very good idea. You can try and find quality companies that are trading at a similar valuation elsewhere. So, for example, SATS is trading at a 23 PE, 23 forward PE. Google is trading at an 18 forward PE. So there's some discrepancy there in terms of the quality as well as the valuation. So there are a lot of different quality stocks that you can find elsewhere in the US, in the European market, as well as the Chinese market. So those are the stocks that you want to buy, not your Singapore stocks.